Good afternoon, ladies and gentlemen and members of the press. The Monetary Policy Committee met on the 20th and 21st of November 2017 against the backdrop of a relatively optimistic global economic outlook. The committee reviewed key developments in the global and domestic economies during the first 10 months of 2017 and assessed the risks to price and financial stability in the short to medium term, as well as the outlook for the first half of 2018. 9 members of the MPC were present at this meeting. External developments. Global output is projected to improve to 3.6% in 2017 from 3.2% in 2016. The revised growth forecast reflects the uptick in global economic activity, strengthened by the recovery in oil and other commodity prices, and leading to improved aggregate demand. Growth in the advanced economies is expected to improve to 2.2% in 2017 from 1.7% in 2016. Similarly, emerging markets and developing economies are forecast to grow at 4.6% in 2017, up from 4.3% in 2016. The MPC, however, noted some risks to the outlook for global growth, to include continued tension in the Korean Peninsula, complexities arising from the Brexit negotiation, and financial market uncertainties due to monetary policy normalization in the United States. The committee noted the pace of increase in inflation in the advanced economies, with the exception of the United Kingdom, is expected to be considerably slow towards the end of 2017. In the emerging market economies, inflationary pressures have abated as key economies exit recession and their currencies stabilize. Inflation is projected at 1.7% and 4.2% in 2017 in the advanced and developing economies respectively. The committee observed that the outlook for global monetary policy remains largely accommodative in support of economic recovery and growth. Data from the National Bureau of Statistics indicate that real gross domestic product, GDP, grew by 1.4% in the third quarter of 2017, up from 0.72% revised, and contraction of 0.91% in the second and first quarters of 2017, respectively. The major drivers of real GDP growth were agriculture, 0.88%, and industry, 1.83%. Some subsectors contracted, including construction, 0.01%, trade, 0.29%, and services, 1.02%. Overall, non-oil real gross domestic product contracted by 0.76% during the third quarter of 2017. Given credence to the argument that more work is required to consolidate the recovery process by putting in place policies that will boost growth through the non-oil sector of the economy. The committee also noted the continuous positive outlook based on the Manufacturing Purchasing Managers Index PMI, which stood at 55.0 index points in October 2017, indicating expansion in the manufacturing sector for the 7th consecutive month. 11 of the 16 subsectors reported growth in the review period. Also, the composite PMI for non-manufacturing sectors stood at 55.3 index points in October 2017, indicating growth for the 6th consecutive month. The committee hopes that while the economic recovery appears to remain fragile, a tenacious implementation of the 2017 budget and quick passage of 2018 budget would boost aggregate demand and confidence in their economy. The committee noted that money supply contracted by 5.54% in October 2017 annualized, in contrast to the provisional growth benchmark of 10.29% for 2017. The development in M2 is largely due to the contraction of 37.5% in other assets net. Similarly, M1 contracted by 7.79%, annualized to minus 9.35%. Net domestic credit expanded by 1.18%, annualized to 1.42%, driven primarily by net credit to government, which also expanded by 7.6% against the programmed growth of 33.2%. Credit to the private sector, however, contracted by 0.24% in October 2017 compared with the provisional benchmark of 14.88%. The Monetary Policy Committee also noted the structural constraints in the transmission of credit to the real sector of the economy, as well as the rising unemployment level. The committee urged the management of the bank to continue to encourage deposit money banks to accelerate the rate of credit growth to the real sector of the economy. Inflationary pressures in the economy continue to moderate, with headline inflation year-on-year receding for the 9th consecutive month to 15.91% in October 2017 from 15.98% in September 2017. Food inflation fell marginally to 20.3% from 20.32% in September, while core inflation increased slightly to 12.14% from 12.12% during the same period. These developments were attributable to the contraction in money supply, favorable but dwindling base effects, and the relatively stable naira exchange rate. In spite of the marginal decline in food inflation in October, the committee noted that the rate remained high, traceable to cross-border sales, distribution bottlenecks, rising prices of farm inputs, supply shortages, as well as ongoing harvest of some farm produce. Money market interest rates oscillated in tandem with the level of liquidity in the banking system, as the average interbank core rate, which opened at 12.0% on October 3, 2017, closed at 5.38% on November 16, 2017. The open buyback rate, OBB, opened at 10.41% and closed lower at 6.02% in the same period. However, the average interbank call and open buyback rates for the period stood at 10.94 and 10.15% respectively. The development in the net liquidity positions and flows reflected the effect of Federation account payments to states and local governments, remittances by the Nigerian Customs and the Federal Inland Revenue Services, OMO sales, foreign exchange interventions, and maturing CBN bills. The committee noted the continuing improvement in the level of external reserves and the equities segment of the capital market. External reserves grew to 34.9% at the close of business on November 16, 2017. Similarly, the all-share index rose by 3.38% from 35,504.62 on August 31, 2017 to 36,703.58 on November 17, 2017. Market capitalization improved by 4.35% to 12.77 trillion naira from 12.24 trillion naira during the same period. Relative to the end of December 2016, capital market indices rose by 36.57 and 38.1% respectively, indicating rising investor confidence due to improvements in the foreign exchange supply. Total foreign exchange inflows through the central bank declined by 6.61% in October 2017 compared with the previous month and attributable to the decline in crude oil and gas receipts as well as revenues from petroleum profit tax and royalty payments. Total outflows, however, increased by 18.7% during the same period as a result of interbank sales, direct payments, and JVC calls. The committee noted the gradual convergence between the rates at the Bureau de Change and the Nigerian autonomous foreign exchange market segments, as well as the stability of the exchange rate at the interbank segments of the foreign exchange market during the period under review. Similarly, the committee reviewed with satisfaction the growing patronage at the investors and exporters window of the foreign exchange market and attributed the development to increased confidence by foreign investors and the preference of the Nigerian investors and exporters window compared with all other windows. The MPC noted that the investors and exporters window had increased liquidity and boosted confidence in the market with over $18.7 billion in transactions since its introduction in April 2017. Forecasts of key macroeconomic variables indicate a positive outlook for the economy up to the first quarter of 2018. This is predicated on continued implementation of the 2017 budget into early 2018, anticipated improvements in government revenue from the implementation of the voluntary assets and income declaration scheme, as well as favorable crude oil prices. The development finance initiatives by the central bank in the real sector, particularly to the agricultural sector, are expected to continue to yield positive results in terms of output expansion and job creation. Focusing on the downside risks to the outlook, committee noted the low fiscal buffers and weak aggregate domestic demand. On the external front, widening global imbalances and rising geopolitical tensions were some of the crucial risks identified by the committee. The considerations of the committee. The committee noted with satisfaction the second consecutive quarterly growth in real GDP following 5 quarters of contraction. In addition, members welcomed the relative stability in the exchange rate, particularly the narrowing premium and the very slow deceleration in consumer price inflation, largely attributable to base effects. Overall, the economy has begun to show strong signs of recovery as public investments has picked up with increased housing construction at the federal and state levels, as well as shipping activities at the ports to support the rising purchasing managers index. The committee was, however, of the view that policymakers must not relent in their aggressive policies initiatives aimed at continuing the positive growth trajectory. The committee was also concerned about potential adverse external developments and the cautious approach to lending and the financial intermediation by domestic deposit money banks. Committee similarly evaluated other concerns in the domestic economy and opportunities for strengthening output recovery, noting that some highly critical sectors were yet to resume growth. The committee also noted the significant contribution of food prices to headline inflation and observed that the benefits of base effect on overall headline inflation has substantially dwindled. Members, however, expressed confidence that the tight stance of monetary policy and the stability in the exchange rate of the naira should continue to positively weigh in on price development and inflation. Committee reaffirmed its commitment to maintaining price stability, which is crucial to sustainable economic growth and development. The committee welcomed the review of the Economic Recovery and Growth Plan in an effort to realize the objectives of the plan. In the same vein, committee urges a quick passage of the 2018 appropriation bill by the National Assembly so as to keep fiscal policy on track and deliver the urgently needed reliefs in terms of employment and growth of the economy. On financial stability, committee noted the concentration of non-performing loans in a few sectors, but observed that the overall condition and outlook for the banking system was stable as deposit money banks' balance sheets remained strong. This assertion is strengthened by the developments in the national accounts and the expectations that the affected sectors are returning to growth. Nonetheless, committee urged for strengthening of supervisory oversight and early warning systems in order to promptly identify vulnerabilities and proactively manage the emerging risks in the banking system. The committee further observed that government was increasing debt, both domestically and externally, thus crowding out the private sector. The committee's decision. In arriving at its decision, the committee appraised potential policy options in terms of the balance of risks. The committee also took note of the gains made so far as a result of its earlier decisions, including the stability in the foreign exchange market and the moderate reduction in inflation, and thus extensively deliberated the options regarding whether to hold, to tighten, or to ease the policy stance. While tightening would strengthen the impact of monetary policy on inflation with complementary effects of capital flows and exchange rate stability, it nevertheless could also potentially dampen the positive outlook for growth and financial stability, as this would constitute a risk to the productive sectors of the economy. On the other hand, whereas loosening would strengthen the outlook for growth by stimulating domestic aggregate demand through reduced cost of borrowing, it could nevertheless aggravate upward trend in consumer prices and generate exchange rate pressures. Committee also feels that loosening would worsen the current account balance of the country through increased importation. On the argument to hold, the committee believes that key variables have continued to evolve in line with the current stance of macroeconomic policy and should be allowed to fully manifest. Members noted that the developments in output and inflation in particular required effective close monitoring in order to gain clarity on the medium-term optimal path of monetary policy. In consideration of the foregoing, the committee decided by a vote of 8-1 to retain monetary policy rate at 14% alongside all other policy parameters. One member voted to reduce the MPR by 100 basis points. Consequently, MPC voted to 1. Retain MPR at 14%, 2. Retain CRR at 22.5%, 3. Retain the liquidity ratio at 30%, and 4. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR. We thank you for listening.